Markets initially crashed after Trump announced far-reaching tariffs on many of the United States trade partners. However, then they ripped higher in a sharp recovery after Trump made the decision to postpone, or you could say pause, his planned tariffs for 90 days while leaving a baseline 10% tariff in place on most U.S. trade partners while they negotiate different deals to try to work out their disagreements before these tariffs take into effect. It's very good news for the Nasdaq and the S&P 500, and sounds like a reason for most investors to celebrate, right? Well, not so fast. While everyone's out here celebrating this so-called relief rally, I'm actually doing the opposite. I believe that the S&P 500 is not a buy right now. In fact, I would rate it a sell. And this video, I'll walk you through exactly why I think this is one of the most dangerous moments for investors to be chasing the markets after they've recovered from the recent dip. And I'll also share where I'm putting my money instead. First of all, if you're serious about protecting your wealth and creating reliable, growing passive income in this chaotic environment, then please smash that like button and subscribe to my channel and stick around. I've got a lot to show you, and the stakes could not be higher today. All right, so let's get right into the content here. Just a couple of weeks ago, President Trump sent out a bombshell post on Truth Social. In that message, he said that the U.S. would pause his original plan to impose steep country-specific tariffs and instead settle for a 10% reciprocal tariff on all goods from U.S. trade partners for the next 90 days. Now, this gives the administration time to negotiate new trade deals individually with U.S. allies like the European Union, Japan, Mexico, Canada, and others. But here's the kicker. China is not included in that 90-day reprieve. And in fact, Trump actually increased his tariffs on Chinese goods further, and the Chinese reciprocated in kind. So now they have tariffs of over 100% on each other. So on the one hand, we've got temporary relief for most of the world, but on the other, we have a full-blown trade war with the world's second largest economy and the world's largest economy in China and the US respectively. And so far, China is showing no signs of wanting to back down, and given their track record, I don't think they're going to, because this is a matter of national pride for both countries and for both leaders. Of course, the markets have recovered quite a bit since they had their initial sell-off in the wake of the tariff announcements. And so that means the markets now, and the media, financial media, is largely saying this is a reason to get back in. The markets have recovered, etc. Even Goldman Sachs has come out and lowered their recession odds based on this development. But let's be absolutely clear, this rally is being fueled by hope, not by fundamentals. And that's a huge red flag for me, because I'm a fundamentals and value investor, not a momentum and hype investor. In fact, if you zoom out a little bit, nothing structurally has changed here. Valuations are still stretched to the extreme, with numerous valuation models showing that the market is near all-time high valuations, is significantly overvalued. The trade war with China actually has gotten worse, not better, and they're expected to be significant earnings headwinds from multinational corporations because of the disruption with trade in China and even the 10% tariffs on a lot of these countries, a lot of the uncertainty and tumultuousness in the markets. And the Federal Reserve is still not riding to the rescue. In fact, Jerome Powell just the other day emphasized that he's not planning to cut interest rates anytime soon. So what is the bull case here? What is going to move the market materially higher? Well, I just don't see one. And in fact, it's certainly not one that I'd want to bet my hard-earned money on. So let's talk some specifics here. The valuation models still scream strongly overvalued. In fact, before tariffs were announced, the S&P was already trading at levels that major valuation indicators flagged as dangerous. For example, the Buffett indicator, which is the market cap to GDP, was well above historic norms. The PE ratio for the S&P 500 was far above its long-term average, and the mean reversion models for the S&P 500 also suggest we're overdue for a significant pullback. And even with the slight pullback in the markets net of the recent recovery, they're still in strongly overvalued territory. Meanwhile, we have the tariffs on China, and that's not just a negotiating tactic. It seems like a real economic war is taking place here between the U.S. and China. And that's not just bad news for China, although of course it is for them. It's a big blow to U.S. corporations that do business there. For example, Apple manufactures a lot of their iPhones there and sells a lot of their iPhones there. Amazon, they bring in a lot of their products from China. Tesla, that's their main profit center. Microsoft, Starbucks does a lot of business there. There are huge components of the S&P 500 that are doing a lot of business in China. Nvidia is getting increasingly hit as well from the trade war with China. In fact, Amazon just pulled the plug on a lot of its China orders. And so that's having a tangible impact on them and a lot of the businesses that sell products on Amazon. What about the third reason? Well, corporate uncertainty has skyrocketed. Okay, even though 90-day pause on tariffs, that still leads to a lot of uncertainty for corporations because they don't know what deals will be struck, what the exact details will be. They don't know what supply chains to invest in. They don't know if tariffs are going to come back stronger in 3 months or where things are going to go. And so they're going to have to delay a lot of their capital spending, and that's going to put a disruption into the economy and could very possibly plunge it into recession. And last but not least, the Fed is still taking a fairly hawkish stance. Federal Reserve Chairman Jerome Powell has made it clear the Fed is not planning emergency rate cuts. In fact, he's concerned about inflation getting worse, not better, from these tariffs, and that could further handicap their ability to cut any rates. It also seems like there's a bit of a feud going on between Trump and Powell, with Trump calling for Powell to remove, Powell saying he's not going to leave even if Trump asks him. And so there seems to be more than just objective analysis of the economy going on here. Seems to be some actual politics coming into play, which is not good for the state of the economy. And of course, there's also the bigger geopolitical risk here to keep in mind. And it's really a wild card that not many people are talking enough about. And that's really that a trade war with China risks escalating into a hot conflict. In fact, Xi Jinping may feel like he has nothing to lose if his economy takes a big hit from this trade war, and he may just go all in and roll the dice and invade Taiwan or do something similar. People like Gordon Chang and Kyle Bass, who are both prominent China watchers, are actually warning about this, that they think a cornered CCP might turn aggressive and make a military move against Taiwan even in this year yet. Of course, I pray that doesn't happen, but we'd be foolish to not factor it into our investment analysis. Again, I'm not saying completely abandon the market and just panic and expect World War III to start any minute, but you should have at least part of your portfolio hedged against this potential outcome. Because if that were to happen, we'd likely be plunged into a global depression because of the importance of Taiwan to the global economy with semiconductors. Not to mention it would be completely shutting off China and the US from each other economically, which again, that would be a huge disruption because they're the world's two largest economies and major trading partners. And this would make, for example, the COVID-19 2020 crash and recession look very mild by comparison. In fact, it would probably even make the 2008-2009 financial crisis look mild. We'd probably think more like the Great Depression or even worse. But I don't see any of this priced in the current broader market indices. They're, again, still trading in strongly overvalued territory near all-time highs. So again, I think more people need to take this into account. So with all that said, where am I investing instead? Well, it's pretty simple. I'm focused on precious metals like gold, silver, and undervalued blue chip gold miners because these are hedges against both inflation and against geopolitical risk and chaos. There's no counterparty risk with gold bullion or silver bullion. And so if China were to invade Taiwan, or we simply just went into a recession and we had an inflationary recession due to tariffs, I think gold and silver, especially gold, although silver is very undervalued as well, could do really well in that sort of environment. And meanwhile, miners are leverage plays on gold. And so if they're undervalued to begin with and gold goes up, that's going to make miners go up even higher. And they've already soared a lot higher even since I began buying them early this year, late last year. I'm also investing heavily in dividend stocks, especially defensive dividend stocks that have strong balance sheets, recession-resistant business models, inflation-linked contracts, sell at attractive valuations and offer attractive yields, and ideally will not be impacted too significantly by the ongoing trade war. So think of companies like Enbridge, WP Carey, Realty Income, Enterprise Products Partners, companies like that. These are companies that you can hold, sleep well at night, know you're going to be collecting steady, growing dividends from these companies rather than rolling the dice on overvalued indices like the S&P 500. So to sum it all up, the 90-day tariff pause is not a green light to go all in on the market. In fact, the S&P 500 remains extremely risky on a valuation and risk-adjusted basis. And with China tariffs escalating rather than easing, that has serious economic and geopolitical consequences for the economy. And so instead of buying the rip, I'm protecting my capital in real assets and defensive income stocks that I can trust in any environment. So if you appreciate this video, if it gives you some food for thought as you think about setting up your own investing portfolio, please give this video a like to help it reach a broader audience. Be sure to subscribe to receive similar content like that in the future. And I also wanted to share with you that my investing group at Seeking Alpha, High Yield Investor, it's the top ranked dividend investing group on Seeking Alpha. And I share all my latest trades in my portfolio, what kind of mining stocks I'm buying, how you can earn a yield on bullion without capping your upside potential, some of the top defensive, undervalued, high yielding dividend stocks today. Check out my subscription. I'm offering a limited time 20% off sale. You can see that in the comments on this video. Thank you very much. See you next time.